Have you ever heard of someone who gets a property they flipped under contract for $500,000, but then the appraisal comes back at $475,000? And then you go and look it up on the county assessor's website and it shows $380,000 of value. So what is the real value here? Today, it's all about value. We're going to talk about 3 different types of property valuation, plus we're going to go over what the loan to value ratio is. Let's get started. Valuation number 1 is market value. This is what the market is willing to pay for a property. So when a willing buyer and a willing seller come together, they're both informed, they're not under any pressure, and they reach an agreed upon price, that's the market value of the property. Market value is based on a number of factors, including supply, demand, location, condition of the property, timing, and so on. The bottom line is that if there are 3 other properties just like yours that sold for $400,000, chances are you're going to find a buyer who's willing to pay about $400,000. If you're listing it for $450,000 because you think it's worth more for some reason and you're not getting offers or you're not getting offers at that amount, the market says it's not worth that amount. It's probably worth $400,000. So the market value is what matters when you're listing a property or when you're making offers on properties that are listed. Valuation number 2 is the appraised value. So this is the way the lender confirms the market value before they'll loan on a property. It's their double check of that amount shown on the contract using a licensed independent appraiser. The appraiser uses recent comparable sales, the property's condition, and local market data to determine what the appraised value should be, and this is how the bank will lend on the property. So if you have a property that you want to buy for $400,000, but the appraisal only comes in at $380,000, you have some decisions to make. You can either bring an extra $20,000 to the closing table, or maybe you have to walk away from that property if you can't renegotiate the price down based on that appraisal. So that appraised value is really important because it determines what a bank will lend on a property. This can be tricky sometimes because occasionally appraisals will lag the market slightly, which is really difficult, especially in a fast-moving market where prices are really rapidly rising. So the bottom line is that the appraisals protect the lender, not the buyer or the seller. So if you're doing a BRRRR or a flip, you really want to think conservatively about what that appraised amount will be. Valuation number 3 is the assessed value. And this is the value that the county government assigns to the property for property tax purposes. Usually it's about 70 to 90% of the market value of your property, and they'll update this amount every 1, 2, or 3 years. It depends on what county you're in because it's done at the county level. So there are some layers to this and how the county determines the value in their eyes, the assessment value, and the actual tax amount on your property. So let's go through a quick example of this. Let's say I have a property here in St. Louis County that appraised for $350,000. My market value is $350,000 and the appraisal came in right at $350,000 when I was getting my loan. St. Louis County appraises it at about 80% of that value, so at $280,000. Now the county has this $280,000 appraisal and then they give it an assessment value of 19% of that. I know it's a lot, but keep following me here. So 19% of $280,000 is $53,200. That's the assessed value that the government will use for deciding my property tax amount. In St. Louis County, the annual tax rate is $8.50 per $100 of assessed value. So that $53,200 divided by 100 is 532 times the $850 per $100 of assessed value gives me an annual tax amount of $4,522. I know that's a lot. The bottom line here is that the government likes to make things a little complicated, but the assessed value is really only for tax purposes. It's not what you should be considering when buying or selling properties, because as you just saw from the silly amount of math we went through just to get a tax bill, it's not a direct reflection of the market value of the property. So those are the 3 types of valuations I wanted to cover today. Market value is what the market would pay for a property. The appraised value is how the lender confirms that market value for lending purposes. And the assessed value is the value the local government assigns for property tax purposes. All right, so a little bonus information is understanding the loan to value or LTV ratio. The loan to value ratio reflects how much a lender is willing to give you for a loan on a property. It's expressed as a percentage and it measures how much the loan is as a percentage of the appraised value. Again, the bank wants to cover their bases, so they get a licensed appraiser to go out and confirm that market value, and they use the appraised appraised value to determine what percentage they're willing to give you. So for instance, if I'm buying a property that is appraised at $400,000 and the bank is willing to give me a $300,000 loan on that property, then I'm getting a 75% loan to value ratio. 300,000 divided by 400,000 is 75%. That is the loan to value ratio I'm getting from that bank. Lenders set these loan to value ratios, first of all, to make sure that the buyer has some skin in the game, but also to cover their bases in the worst case scenario that they have to foreclose on a property. If they have to take that property from you, they want to know that there's a little bit of upside or buffer in the value so that hopefully they can resell it for about what you owe on it. That doesn't always happen for them, but this is basically them mitigating their risk as much as possible in case they do have to foreclose and take back a property. So as you can imagine, lower loan to values, say 70% versus 80%, is a lower risk to the lender. So you're likely going to get a better interest rate. You won't have to pay things like mortgage insurance. You're going to have better overall terms with a lower versus a higher loan to value ratio. Commonly, loan to value ratios are in the 75 to 80% range. However, there are some instances where you can get 90 to 100% loan to value, but those are in special cases, like if you have a VA loan or an FHA loan for a primary residence. So you can use these if you're house hacking, but you do have to live in the property generally to get these 90 to 100% loan to value options on a loan for a property. So again, just remember, loan to value represents the amount of the loan as a percentage of the appraised value of the property, and generally a lower LTV means better loan terms for you. Every property has multiple values. Understanding the meaning and the use of these different valuations is really important for your career as an investor. I hope this was helpful for you. If it was, please hit that thumbs up, subscribe to the channel. Make sure you drop any questions you have in the comments below. Most importantly, keep learning, keep growing, and have fun.